Welcome back. We are in earnings season that typically moves markets. It is underway with the major banks like J.P. Morgan, Citigroup, Wells Fargo, all reporting this week. Joining us right now is Federated Investors Chief Equity Strategist Phil Orlando. Phil, good to see you.
Thanks for having me,
And I was happy you were coming on because you look at this market based on fundamentals.
Absolutely.
The fundamental backdrop of earnings tells us
the earnings recession is over. This is going to be a very strong first quarter. FactSet is out with about a 9% year-over-year increase, which is pretty good. But pre-announcement season so far, it's been crickets and tumbleweed. What that tells us is the numbers are going to be pretty strong. We're thinking sort of 13 to 15%, so it's going to be a surprisingly good quarter.
So does the market expect that? We're still looking at a market that's up 13% since Election Day.
The market seems to be focused on the scrum that's going on in Washington right now. There's not a lot of attention being paid to earnings. And as we were talking off camera, GDP for the first quarter isn't going to be particularly good, probably a 1 to 2% kind of number. So I think if we get good earnings in the first quarter and some decent guidance from managements, I think we can take another leg up.
Wow.
So energy is a big part of this.
Right.
Prices have stabilized. We're off good comps from last year. What's happening outside of energy? Is there anything besides the energy story that's driving earnings growth that could sustain it through the rest of the year?
Well, your point on energy is a valid one, the $26 bottom we saw in the first quarter a year ago. So energy prices are double from where they are. That has a derivative impact through a lot of the cyclical elements of the economy. Additionally, the financial service companies, I think the banks, you're going to see report some decent numbers this week as well. So those areas, I think the cyclical elements of the economy, including energy, plus financial services, that whole economically sensitive complex, we think will do pretty well.
And yet we see car sales softening and inventories rising in the automakers. Are consumer durables really going to hold up in this kind of environment?
Consumer durables is an area that we're not particularly excited about right now. Outside of media, autos is an area that absolutely has slowed. We topped out at about 18 million units sold on an annualized basis in the fourth quarter of last year. I think the most recent data point we saw was sub 17. So there's definitely been a slowing of autos. We think that will pick up as we get into the summer, but the last couple of months has definitely slowed down.
But last week we have now the reintroduction of geopolitical risk that, at least in the stock market, didn't seem like it was factored in any significant way. And yet that weaker than expected jobs report, how does that not shake stocks, at least in the short run? The
jobs report was a complete fallacy. It was all weather. It was all Stella. When you dig into the numbers, and this was the piece that I wrote on Friday, Winter Storm Stella took place right smack in the middle of the Labor Department's survey week. The claims data 2 weeks before was at a 44-year low. The claims data 2 weeks after was almost back at that level. Claims were elevated during the survey week. That impacted the jobs report by perhaps as many as 100,000 jobs. You look at the ADP report, which was at a 2-year high. You look at the household survey.
Yeah, there are almost 500,000 jobs created in the household survey.
So as we get back in April, next month's number, a month from now, we're going to see a significant snapback and maybe a positive revision. So, for example, reading the New York Times version Saturday morning of the jobs report, I didn't see any discussion of weather. Stella was the story for the jobs report. That's why they missed by 100,000 jobs.
Stella was the story.
Stella was the story.
So you just take out the weather and then just look at really what you're saying that was just a temporary thing.
Right. The underlying trend for the labor market is very strong. That 98,000 print that we saw could have easily been a 200,000 print.
But what does that mean for corporate profit margins? Because what we're seeing is less slack in the labor market and wage pressures. So how is that going to affect corporate profit margins if they have to pay workers more and there's not a lot of pricing power?
Unit labor cost is absolutely going up. So the key here is productivity. And the boost in productivity we're going to get is going to be, regrettably, tied into the successful passage of Trumponomics. And right now, that is the $64,000 question.
Well, that's right. I mean, everything, and as Dagan mentioned, we were all expecting this early when the president first took office. And now it looks like we're not getting health care this year. We may not get tax reform until the end of the year. It's certainly not going to have an impact on 17. So did this rally of almost 13% since Election Day, is it being built on something that perhaps is not materializing until further out?
Well, that's certainly the risk. Look, best case scenario, Maria, is that we were not going to get Trumponomics passed at the earliest before the August recess, with possibly having it made retroactive to the beginning of the year.
And it's not going to be that, I don't think.
Because it looks at this point that it's going to take till the end of the year or maybe the very beginning of next year.
Yeah.
Look, there are some members of Congress that are secretly happy about this, because if it gets past the beginning of next year, based upon the lags associated with this, the economy perks up in the second half of this year, just as everyone is going home to run for election in November of 18. So maybe there's a Machiavellian timing element here that everyone's trying to do it this way.
What's the most important part of this, of the tax reform for the market? What do they want to see more than anything else? Individual rates, corporate rates, border adjustment? What do they really want?
I'm not a fan of border adjustment. The element that I like the best is the reduction in the corporate tax rate from 39% down to 20%.
You might have to go to 25. That's another thing that they're going to be debating. Is it 20%? Is it 25%? Trump started off with 15%. We haven't heard that in a while.
Well,
so I guess it is close to 20%.
15, in our view, was too low. Something in the 20 to 25% neighborhood makes sense.
Then that would be okay.
I think that would be okay. The key thing is you want to get the rate down from the 39% rate to at or below the global corporate average, which is 25% right now.
Mike, jump in here, Mike.
You seen Boss Baby? I got nothing.
You look at me like you wanted
smart guy like this.
You wanted to ask Bill, did you see Boss Baby?
I did have a question, but I think we're running out of time, which was we're talking about things that are built on something down the road in the future.
Yeah.
Just a quick thought on, does it make sense that I know this is a little off topic, Tesla being valued at or near par with General Motors?
That's a great question.
Thank you.
Tesla is not a company that I follow closely. I know the valuation has been great, but I don't really know the underlying fundamentals that well in terms of what their trends have been in terms of unit
you look at Tesla versus GM and Ford, and then you look at Amazon versus Walmart. Got some crazy valuations out there. Do they make sense? You
get back to the same thing we saw as the internet bubble was sort of growing back.
Is that where we are right now?
Well, in terms of looking at the valuation of a Ford or a GM versus a Tesla, it raises a lot of the same questions.
Okay. Very politically correct, you said that. Good to see you, sir.
Thank you, Mary.
Thank you so much.
Happy
Phil
Easter
Orlando,
to you.
happy Easter to you, Federated Investors.